When professional investors evaluate international markets, the central question is rarely whether an opportunity exists. The more important question is how that exposure fits within a diversified portfolio and how it affects overall risk and return characteristics. This video explains how Saudi stocks are typically used within professionally managed portfolios, how investors think about position sizing, and why Saudi exposure is generally treated as a complementary allocation rather than a core holding. Saudi Arabia represents a large and strategically important market, particularly due to its role in global energy production and its evolving capital markets. However, professional investors do not evaluate Saudi exposure in isolation. It is considered alongside other international and emerging market assets as part of a broader allocation strategy. One of the first considerations is position size. Professional investors rarely allocate large portions of a portfolio to any single emerging or transitional market. Instead, exposure is sized conservatively to balance potential upside with manageable downside risk. This approach reflects a core principle of portfolio management: diversification matters more than conviction. Even markets with attractive fundamentals can experience periods of volatility driven by factors outside an investor's control. Saudi exposure is often grouped within a broader international or emerging market allocation rather than treated as a standalone investment. This reduces sensitivity to country-specific events and helps smooth portfolio performance over time. Sector concentration is another critical factor. Saudi markets tend to have significant exposure to energy, financial services, and telecommunications. Professional investors assess how this sector mix interacts with existing portfolio holdings. For example, investors who already have meaningful exposure to global energy companies may limit additional concentration, while those seeking income or inflation-sensitive assets may view Saudi exposure as a useful complement. Liquidity considerations also influence positioning decisions. Many American investors access Saudi exposure through exchange-traded funds listed on U.S. exchanges. These vehicles offer daily liquidity, transparent pricing, and ease of rebalancing. Liquidity is essential for portfolio management. It allows investors to adjust exposure as market conditions change without disrupting broader allocation targets. Rebalancing discipline plays an important role in how Saudi exposure is managed over time. Professional portfolios are reviewed periodically to ensure allocations remain aligned with strategic objectives. When Saudi assets outperform and exceed target weights, positions may be trimmed. When performance lags or valuations become more attractive, exposure may be reassessed. This disciplined approach helps manage risk and avoids emotional decision-making. Currency structure is another consideration. The Saudi riyal is pegged to the US dollar, which reduces currency volatility relative to many emerging markets. For American investors, this can make Saudi exposure more predictable within a global portfolio. However, reduced currency volatility also limits potential currency-driven returns. Professional investors account for this trade-off when modeling expected performance and assessing diversification benefits. Risk management remains central to portfolio positioning. Saudi exposure is evaluated in the context of energy price sensitivity, regulatory frameworks, geopolitical dynamics, and global market conditions. Rather than attempting to forecast these variables precisely, professional investors focus on position sizing and diversification to manage uncertainty. The goal is not to eliminate risk, but to ensure that no single risk factor dominates portfolio outcomes. Another important consideration is time horizon. Saudi exposure is rarely used as a short-term trade. It is more commonly positioned as part of a longer-term allocation strategy designed to capture structural growth, income potential, and diversification benefits over time. This long-term perspective aligns with how institutional investors and wealth managers construct portfolios. Individual markets are tools within a broader strategy, not isolated bets. Correlation also matters. Professional investors evaluate how Saudi assets move relative to other portfolio components. Assets that behave differently during various market conditions can improve overall portfolio resilience. Saudi exposure may offer diversification benefits due to its unique economic structure and sector composition. However, these benefits are evaluated empirically rather than assumed. From a portfolio construction standpoint, Saudi exposure is often paired with other international assets to balance risk factors such as energy sensitivity, geographic concentration, and income characteristics. Importantly, professionals remain flexible. Portfolio positioning is not static. As markets evolve, allocations are adjusted to reflect new information, changing risk profiles, and evolving investment objectives. For American investors, the key takeaway is that Saudi stocks can play a role in a diversified portfolio, but that role should be clearly defined. Position size, sector exposure, liquidity, and overall portfolio balance matter more than short-term performance. This disciplined approach reflects how professional investors think about markets. The focus is not on predicting outcomes, but on building portfolios that can perform across a range of scenarios. This content is provided for educational purposes only and does not constitute financial advice. For a structured overview of access methods, risks, income characteristics, and portfolio positioning, download the full Saudi market guide linked in the description.